For decades, the Indian saver has relied on a single, unchallenged financial reflex: the bank fixed deposit. It is the cultural default for safety, the place where we park our money so we don't have to worry about it. But leaving capital stagnant carries a hidden cost. Inflation acts as a persistent force on that money, quietly eroding its purchasing power year after year. This chart shows how that erosion happens in real time. If you secure a standard 6.5% return on an FD, and then account for your tax bracket and a 5% inflation rate, your real return, the actual growth of your wealth, is often negative. Your money is technically growing, but it's buying less. Then there is the structural risk. Bank deposits in India are insured by the gsec, but only up to 5 lakh rupees per bank. Any balance above that red line is technically an unsecured loan you are making to the bank. If the institution fails, that surplus capital is exposed. For investors managing large pools of capital, retirement funds, property sales, or business surpluses, relying solely on the safe bank default actually creates a highly concentrated risk. To solve this, we have to look at how institutional investors secure their cash. They don't rely on bank FDs, they buy government debt. And recently, the barrier to entry for those markets has been removed. The Reserve Bank of India launched the RBI Retail Direct platform, a gateway for everyday individuals to purchase government securities directly from the central bank. The core mechanics of the scheme are straightforward. There are no account opening fees, no maintenance charges, and no commissions. You own the sovereign assets directly in your own name. Previously, retail investors routed investments through mutual funds or life insurance companies. Those intermediaries took a percentage of the yield as an expense ratio. Today, the Retail Direct Gilt account bypasses those intermediaries entirely. By removing the gatekeepers, the government has placed the individual directly at the auction table. The only choice left is deciding whether to buy the debt of the central government or the debt of individual Indian states. This matrix shows the direct trade-off between a bank FD and a state development loan, or SDL. On the safety front, the FD caps your protection at 5 lakh rupees. The SDL carries sovereign safety for the entire invested amount, whether it's 10,000 rupees or 10 crore. State development loans are issued by state governments to fund infrastructure and fiscal deficits, but they are managed directly by the RBI. Because of this centralized control, they carry an implicit sovereign backing. The risk of a state defaulting on an RBI-managed loan is effectively zero. But that absolute safety comes with a penalty in liquidity. You can break a bank FD instantly, usually by sacrificing about 1% of your interest. To exit an SDL early, you have to sell it to another buyer on the RBI secondary market, known as NDSOM. That introduces interest rate risk. Bond prices move in the opposite direction of market interest rates. If you buy a bond paying 7% today, and next year the RBI raises rates so new bonds pay 8%, nobody will pay full price for your 7% bond. If you are forced to sell it early, you will have to sell it at a discount, taking a loss on your principal. However, this risk only applies if you sell early. If you hold the SDL until its exact maturity date, the market price fluctuations do not matter. You receive your full principal back, guaranteed. State development loans trade the click-of-a-button convenience of a bank app for vault-like structural safety. They require you to commit your capital for a specific timeline. If you are willing to make that time commitment, you have to choose which sovereign bond to buy. Central government securities are the baseline, but state development loans offer a specific numerical advantage. This chart compares recent yields. A standard 10-year central government bond pays around 6.97%. But a 10-year SDL issued by a state like Uttarakhand pays 7.70%. That difference, about 0.73% in this case, is known as the yield spread. It is the extra return you earn because the market perceives the finances of an individual state to be slightly riskier than the central government. But there is a gap between perceived risk and actual risk. While state finances vary widely, the RBI orchestrates the repayment mechanics for both central and state debt. The RBI auctions these securities through its dedicated electronic system, eKuber, and strictly manages the borrowing limits for every state. Because the RBI is operating the plumbing behind the scenes, an SDL effectively offers a free lunch. You get a higher yield without taking on a proportionate increase in default risk. This timeline illustrates the cash flow mechanics of an SDL. These are long-term instruments, typically issued for periods ranging from 7 to 30 years. Once you buy in, the state pays you interest semi-annually. Every 6 months, the cash drops directly into your linked bank account. That coupon rate is locked. Regardless of what the stock market does or how the broader economy performs, that income stream remains mathematically predictable until the bond matures. To manage the long lock-in periods, investors use a strategy called bond laddering. Instead of putting all your money into a single 15-year bond, you build a structured staircase of maturities. You split your capital and buy different bonds that mature at spaced intervals, say one maturing in year 5, another in year 6, and another in year 7. When the first bond matures, you gain access to a chunk of your principal. If you don't need the cash for expenses, you reinvest it at the far end of the ladder, securing whatever the highest current yield is at that time. And if you face an emergency and need cash immediately, you don't necessarily have to sell the bonds at a loss. SDLs are eligible collateral. You can pledge them to a bank to secure a short-term loan. A laddered SDL portfolio allows you to lock in high yields for decades while still ensuring periodic liquidity. It turns the passive-active saving into a proactive system for managing income. Setting up this system requires passing through the RBI's digital infrastructure. This checklist shows the exact prerequisites for opening a retail direct Govt account, a rupee savings account, your PAN, an Aadhaar card for KYC, and an active email and mobile number. You register on the RBI Retail Direct portal. The system verifies your identity through an OTP and links directly to your existing bank account. Once inside, you can access the primary auction. This is where the RBI issues new bonds on behalf of the states every fortnight. You do not have to bid against massive institutional banks. The RBI reserves a specific portion of every auction for individual investors under the non-competitive bidding scheme. You simply request the amount you want to buy and accept the final yield determined by the institutional auction. This flowchart tracks the money. When you place a bid, you authorize a UPI mandate. The funds are blocked in your bank account but not debited yet. If the bond is allotted to you on the settlement day, the money is officially debited and the bonds are credited to your account. There are no physical certificates. The entire holding is digital, tracked directly in the central bank's ledger. The user interface is built for institutions, so it lacks the polish of modern consumer trading apps. But navigating that slightly rigid portal is the exact mechanism that saves you the fees usually charged by wealth managers. This decision tree simplifies the choice. If you are going to need your capital within the next 1 to 3 years for a down payment or a planned expense, stop here. Stick to bank fixed deposits. The liquidity penalty of bonds is too high for short-term cash. But if your time horizon stretches past 7 years and your goal is generating consistent long-term income, open the RDG account. And if you want to maximize the return on that sovereign safety, capture the yield spread by purchasing state development loans. State development loans aren't meant to double your money overnight. They are foundational anchors. They exist for investors who prioritize absolute capital safety and predictable cash flow over market timing.